You kept the old sedan because it was paid for and reliable. Then the mail started to change. Insurance renewed higher. A banknote said the promo ended. The dealer called with best offers of the year. You went in, saw banners, saw rebates, and still the monthly barely moved. The lot was full. The math was not. Neighbors bragged about deals and whispered the number. $800 a month, give or take. You drove home, priced tires instead, and asked the only question that matters at this age and income. If prices are down, why doesn't the payment drop? The answer isn't in the ad. It's in the stack behind it. The car payment now feels like a second rent. Insurance went up. Service isn't cheap. Dealers advertise bigger discounts, but the check each month still hurts. That's the first sign something changed. Not at the showroom, in the budget. Here are the numbers that matter. In September 2025, the average price actually paid for a new vehicle hit a record $50,080, the first time ever above $50,000. Incentives also hit their 2025 peak, averaging 7.4% of price, about $3,700, yet the payment didn't get light for most buyers. Supply piled up. By early October, new vehicle inventory reached about 2.87 million units, with days supply around 84 in September, the highest levels of the year. When cars sit, discounts grow. But discounts can't erase high prices and financing costs. Used is cheaper, people say. Not always in practice. The official inflation report shows used car prices fell 0.4% in September versus August. But that's a monthly wiggle, not a collapse. Shoppers still face high levels, and many young used vehicles didn't drop enough to transform the payment. Sales cooled. The August selling pace, say IR, ran near 16.1 million, but momentum faded into fall as buyers stepped back. Inventory rose, incentives rose, prices still printed records. A mix that tells you demand is cautious, not gone. So why doesn't cheaper on paper fix the bill? Because the payment is a stack. Price minus incentive, plus taxes and fees, multiplied by your APR, then you add insurance. At $50,000 financed, even a $3,700 rebate trims roughly $60 a month on a 60-month loan. Easy to lose when insurance renews higher. That is why the ad headline and the monthly check disagree. Facts in 60 seconds. The anchor for this story. Record new car ATP $50,080 in September. Incentives, your 7.4% of ATP, $3,700, the high for 2025. New vehicle inventory, for 2.87 million with 184 days supply. Used car CPI, 0.4% month over month. August sales pace, 16.1 meter CRR. These are not opinions. They are price tags, lots full of cars, and federal data. If cheaper doesn't show up in the payment, the problem isn't the sticker, it's the stack. Next, price tags versus payments. Why one moved down a little and the other didn't. Then, little choice, few discounts, pandemic shortages. People bought what was on the lot and paid whatever it took. Now, the lots are full, incentives are back, but payments still bite. Start with prices. In September, the average price actually paid for a new vehicle hit $50,080. First time ever above $50,000. That alone tells you more inventory did not mean cheap cars. Look at stock. Dealers entered October with about 2.87 million new vehicles and roughly 84 days supply, the highest levels of the year. When cars sit, manufacturers raise incentives. They did. Average incentives reached about 7.4% of price, or roughly $3,700 per vehicle, the peak of 2025. So why doesn't it feel easier? Because the market mix changed. More expensive trims, trucks, and EVs pushed the average up even as discounts grew. Headlines about deals are true. The payment is still high because the car itself is pricier than the one you bought 10 years ago. Demand cooled, not collapsed. The August selling pace was about 16.1 million NARs, CIR, down 2.9% from July. Sales kept moving, but slower, which is why inventory piled up and incentives rose. A slower pace with fuller lots is pressure on price tags, not a guarantee of lower monthly checks. Used prices add confusion. Government data showed used car prices down 0.4% in September from August. That is a small monthly dip, not a big break. Shoppers looking at young used still see stiff numbers. This is why some buyers find a new model with a big rebate close in price to a 2-year-old used one, and still walk away because the payment won't budge. One more piece. Brand by brand, the story differs. Several marques now sit above 100 days supply, so specials get deeper on those specific vehicles. Others are tighter and hold the line. The average hides these splits, which is why your neighbor gets a strong deal while your quote barely moves. Bottom line, without jargon. Then, low inventory, low incentives, fewer choices. Now, high inventory, higher incentives, record average prices. The discount is real, but the mix and financing erase much of the relief. The decision at the kitchen table isn't, is the sticker lower? It's, is the payment lower? Next, the payment itself. How APR, term, taxes, and insurance turn a headline rebate into the same monthly number. The ad says the price dropped. The payment does not. That is the confusion most shoppers face now. A rebate shows up on the quote, but the monthly number barely moves because the payment is a stack. Price, taxes, and fees, your APR, and insurance. In September, the average new vehicle price actually paid crossed $50,000 for the first time. Even with bigger incentives, that high starting point keeps the check heavy. Inventory is high, so dealers and automakers sweeten offers. By early October, there were about 2.87 million new vehicles on lots and roughly 84 days supply, the highest levels of the year. That pressure creates deals, but it does not guarantee an affordable payment when financing costs and premiums are up. Here is a plain example. Finance $50,000. Take off a typical rebate worth about 7% to 8% of price, and you save roughly a few $1,000s. On a 5-year loan, that often means something like $50 or $60 less per month. Many households lose that relief when auto insurance renews higher, or when the APR sits above 7%. The headline sounds generous. The bill is stubborn. Used prices add more noise. The government's inflation report showed used cars and trucks down 0.4% in September from August, while new vehicles edged up 0.2%. That is a small monthly move, not a crash. At the wholesale level, the Manheim Index ticked to about 207 in September, roughly flat on the month, and about 2% higher than a year earlier. Translation: young used has not fallen enough to turn the monthly into a bargain, so a new car with a deep rebate can sit close in price to a 2-year-old model, and the payment still feels large. Demand has cooled, but not collapsed. August sales ran at about a 16.1 million annual pace. Cars are selling, just slower, which is why lots are full and incentives are fatter. Slower sales with fuller lots push stickers down at the edges. They do not fix the financing math at the kitchen table. So the first suspicion becomes a pattern you can explain in one breath. The ad looks better. The loan and insurance eat the gain. The payment barely moves. Families pause or stretch the term to make it fit. Stretching lowers the monthly, but raises total interest paid and keeps you upside down longer. That is why many buyers step back even when the lot is packed. Next comes the push to a decision. A bank letter with a new rate. An insurance renewal a notch higher. A service bill that lands the same week. The math does not care about the ad. It cares about the check you write on the first of the month. The push comes as a letter. The promo rate ended. The payment changed. Insurance renewed higher. The budget that worked in spring does not work in fall. You call the dealer and hear about bigger rebates. You open the calculator and see the same monthly number staring back. Lots are full, so the offers sound generous. New vehicle inventory climbed to about 2.87 million units by early October, with roughly 84 days of supply at the end of September, the highest levels of the year. That pressure creates promotions on paper, but it does not promise a lower bill at home. Prices did not blink. In September, the average price actually paid for a new vehicle hit a record $50,080, the first time it has ever crossed $50,000. Incentives reached their yearly peak at about 7.4% of the price, roughly $3,700 per vehicle. A record price and a record incentive can exist on the same day. The payment still depends on what you finance and at what rate. Here is what that means in plain math. Take a $50,000 transaction. Subtract about $3,700 in incentives. Finance the rest for 5 years. The rebate trims something like $50 to $60 a month. If your APR is near 7% and your insurance renewal is up, that savings disappears in a line or two on the statement. The ad moved. The check did not. The official inflation print adds to the confusion. In September, the CPI showed new vehicles up 0.2% on the month and used cars down 0.4%. That sounds like used cars are getting easier. It is a small monthly dip, not a clear path to a cheap payment. When you shop young used, the sticker often sits close to a discounted new model, and the financing terms can make the monthly similar. Sales have cooled, not collapsed. The selling pace in August ran around 16.1 million annualized. Cars are moving off lots, just slower than midsummer, which is why inventory rose and incentives climbed. A slower market can bend a sticker. It rarely fixes a budget if the rate and the premium do not cooperate. So the decision shifts from, is there a deal, to does the check clear? Families look at the letter from the lender, the renewal from the insurer, and the quote from the dealer. If those 3 pages do not produce a smaller monthly, the answer is simple. They keep the old car another year, or they cut the trim, or they step out of the market and wait. That is the turn in this story. Inventory is high. Incentives are the best of the year. The average price is still a record. The CPI for used cars dipped, but not enough to rescue the monthly. The letter made the choice for you. Next, where the demand went and why many households are pressing pause even with a full lot and a big rebate. He lines up the proof. Sales pace, lot counts, price charts, household bills. Sales first. August ran at about a 16.1 million annual pace. That is healthy on paper, but slower than midsummer. By early October, dealers were sitting on roughly 2.87 million new vehicles and about 84 days of supply, the highest levels of the year. Cars are moving, just not fast enough to shrink the pile. When inventory stacks up, incentives rise, but shoppers still pause. Prices next. September set a record. The average price actually paid for a new vehicle reached $50,080. Incentives also peaked for 2025 at about 7.4% of price, around $3,700 per vehicle. A record price and a peak rebate can exist together. The payment depends on the financed amount and the rate. Many households see the math and wait. Used values are not collapsing. The Mannheim Used Vehicle Value Index was 207.0 in September. That was down a hair from August, but about 2% higher than a year earlier. At the retail level, the CPI showed used vehicles down 0.4% month over month in September, and new vehicles up 0.2%. Those are small moves, They do not turn a large monthly bill into a small one. Brands diverge. Several marques now sit around or above 100 days of supply as 2026 models arrive. Those nameplates cut deeper. Others hold the line. The average hides these splits, which is why a neighbor brags about a big deal while your quote barely shifts. Shoppers notice the gap and walk. Household cash flow explains the missing signatures. As of June, 4.4% of all household debt was in some stage of delinquency, according to the New York Fed. That is millions of families with less cushion. When the card and the mortgage feel heavier, a car purchase becomes optional. People keep the old vehicle, fix the brakes, and wait for either rates or prices to blink. Now stack the pieces in plain order. Full lots and slower sales push incentives up. Record transaction prices and firm used values keep the starting number high. Financing costs and insurance renewals eat most of the rebate. Credit stress trims room in the budget. The outcome is not dramatic. It is quiet. Fewer test drives. More extensions at the service counter. A longer ownership cycle. Shoppers also change targets. Some shift to lower trims or smaller engines and still see the payment they hope to avoid. Others compare a discounted new car to a 2-year-old used one and find the monthly almost the same. The tie goes to the cheapest all-in bill, which is often to wait. Dealers feel it in appointment books. Forecasts for late October already hinted that sales would take a step back from the third quarter's pace. The cars are here. The buyers are cautious. Until the payment falls for real, demand is not zero, but it is on hold. That leads to the family decision. Keep the car another year. Push maintenance now and revisit in spring. Or cut the trim and still walk if the check does not drop. The lot can be full and the ad can be loud, but the signature happens only when the monthly number shrinks on the page in front of you. Here is the plain ending. The problem is not that people forgot how to buy cars. The problem is the payment. New car prices set a record in September at $50,080. Incentives also hit their yearly peak at 7.4% of price, about $3,700. Those two facts can live together. A record price minus a big rebate can still leave a heavy bill. Supply is no longer the excuse. Dealers started October with about 2.87 million new vehicles and roughly 84 days of supply, the highest levels of the year. That is why the ads got louder. But ads do not pay the APR or the insurance renewal. Used values did not collapse. The Manheim Index read 207.00 in September, down a touch from August, but still about 2% higher than a year earlier. In the government's report, used prices slipped 0.4% month over month, while new edged up 0.2%. These are small moves. They do not turn a large monthly into a small one. Demand is not zero. It is on hold. August still ran at about a 16.1 million sales pace. Cars are selling, just slower, which is why lots are full and incentives are up. People are waiting for the payment to move, not the banner. Household cash is thinner. By the end of June, 4.4% of all household debt was in some stage of delinquency, according to the New York Fed. That means fewer families have room to absorb a bigger car bill. When the card and the mortgage are tight, a vehicle purchase waits its turn. So the chain is simple. Full lots push incentives up. Record average prices and firm used values keep the starting number high. Rates and insurance absorb much of the rebate. Budgets tighten. The result is fewer signings, longer ownership, more service visits, and buyers who only move when the math finally clears. What could change next is measurable. If inventories stay near 2.9 million and more brands sit over 100 days, discounts will deepen on specific models. If wholesale values slip in late fall updates, retail used prices may follow with a delay. If rates ease, the same sticker could finally produce a smaller check. The direction will show up first in the next Manheim update, the next CPI for vehicles, and Cox's mid-November inventory read. Cliffhanger. Dealers are planning 2026 model allocations now. If supply keeps rising faster than buyers return, they face two choices: cut sticker harder or slow orders. Meanwhile, a new New York Fed deck will show whether delinquency keeps creeping up into the holidays. The lot is ready. The signatures will wait until one thing happens on paper: the monthly drops for real.